If you're nervous about buying and selling your home and having dates that don't match, let me help you. Often, when you go to sell your home and buy a new home, the dates do not match, and you have to compromise in order to get the best price for your home. This is known as bridge financing. It means you leverage the equity in your home to provide you what you require for the remaining down payment in order to fund the purchase of your new home. An example of bridge financing provides the sale of your home with $100,000 equity after you've paid for the real estate commission, the HST on the real estate commission, less your existing mortgage, the legal fees on both the sale and the purchase of your new home. You then look at what is required for the remaining down payment to buy your new home, which is your deposit with the offer, less the new mortgage that you're going to put together. The difference is the bridge financing that you need in order to buy your new home. How can a secured credit line save you money? Often when you buy your new home, the mortgage that you need is not always equivalent to 20%. Sometimes it's less. However, when you do require bridge financing, it's in your best interest to get a collateral mortgage, a combination of both a mortgage and a credit line, up to 80% of your house purchase. This way, the additional money is a credit line which can be used to provide your down payment, and by doing this, you reduce your bridge loan financing, which can save you hundreds of dollars. Plus, the credit line can be used at a later date at any time to facilitate additional purchases as your lifestyle changes. This allows you greater flexibility and will maximize the interest cost savings for you. What if you sell before you buy? There are also instances in the marketplace where this will happen. And when it does, the owner will be motivated and will grab your offer. However, you need to understand that the existing mortgage that you have will have to be paid out, and any penalties associated with that. Most lenders will reimburse this penalty back to you, providing there is a 90-day difference between the sale of your existing home and the purchase of your new home. And you come back to that lender on the existing terms and conditions of this mortgage. What if you want to keep your property and rent it out instead? More buyers are considering this option, and when they do, they can go back and refinance their existing mortgage to provide a payment along with the condominium fees and property taxes that will carry the rent that they will set for the property. Their property then becomes an investment. They can now go and buy a home with less down payment and have the option in the future to sell their home and maximize the sale price. Having a plan for your mortgage is a key. I would be happy to speak to you on how I can make this work for you. Please call me, Lindsay Doak, Trusted Mortgage Advisor, RBC Financial, 416-464-6423, and let's get started.